Hello, and welcome back to a re-recording of problem 12-3B. Not sure what happened. There was an issue, I guess, technical issue uploading. So, nevertheless, we're going to go ahead and re-record it. So, I checked Blackboard, problem 12-1B, good to go. So, we'll run through problem 12-3B in this video. We'll do another video and re-record problem 12-4B. Okay, so what we have here is a partnership. Okay, and the partnership is Newman Company, and we're liquidating. Right, the partners decided to dissolve the partnership, to liquidate the partnership, take their portion of the assets, and go on their way. So what they give us here is the balance sheet for Newman Company. Okay? And they give us some more information here, right? They tell us that the partnership shares income and loss at a ratio, a 5-3-2 ratio. Okay? During the process of liquidation, the transactions below were completed in the following sequence. So what did they do? Well, first, they liquidated all the non-cash assets, meaning all the receivables, the inventory, the equipment, all the non-cash assets were sold for cash. Okay. They had a gain. We need to recognize either a gain or a loss on allocating the cash to the partners. The liabilities, we're going to pay those in full, and they tell us that cash was paid to partners that had a credit balance. All right, what in the world does that mean? Well, basically what we're doing here is we're taking all the assets that are in the partnership, we're selling them, we're getting cash for them. From that cash, we're going to pay off the liabilities, people that we owe money to. From there, we're going to determine, okay, do the owners have a credit balance in their capital account or a debit balance in their capital account? If they have a capital balance, if they have a credit balance, well then we're going to pay cash to those owners. Okay, so let's go ahead and run through this pretty quickly. Okay, now first thing we got to do is get all the non-cash assets off the books, right? So that's really easy for us to do. Whatever it's on the books for, we got to get it off the books. Okay, so I'm going to pull up Excel. I've already set up Excel to be for our journal entries. So the date here is April 30th, 2017, because that's when they're liquidating. Okay, on April 30th, no more business, no more partnership, sell any assets. So what do we need to do? Well, the first thing we need to do is show that, okay, we got to get some of these assets obviously off the books, right? We got to get the accounts receivable off the books. We got to get the inventory off the books. We got to get the equipment off the books. We need to get any accumulated depreciation off the books, okay? So let's go ahead and first do our journal entry, right? So the first thing we need to do is we need to recognize that, and again, this is April 30th. Okay. First thing we need to recognize is we get cash, right? The problem tells us we got $55,000 in cash. Okay, cool. So I'm going to debit $55,000 cash. The next thing I'm going to do is I'm going to get everything. Let's start with the accounts receivable, right? I need to get the accounts receivable off the books. Okay, so what am I getting them off the books for? I'm going to come down a little bit because I'm going to leave room for our debits here, right? Because remember, debits always go first, credits second. So we need to credit our accounts receivable. Well, how much are we going to credit it for? Well, accounts receivable is on the books for $25,000. I got to get it off the books for $25,000. Okay, good. Now, remember, I need to get the allowance for doubtful accounts also off the books. Why? because the receivables gone, that asset is gone. Well, it has a contra asset associated with it, that allowance for doubtful accounts. I need to get that off the books, right? So it's on the books right now for $2,000. Remember, it's allowance for doubtful accounts, contra asset account. That means it has a credit balance. So I need to debit this, okay? So I'm going to debit allowance for doubtful accounts. And I'm going to debit it for $2,000, okay? Next thing we're getting off the books is our inventory, right? Inventory's on the books for $35,000. So I need to credit inventory for the amount that it's on the books for, $35,000. Now remember, what we're doing here is we are liquidating the partnership. This is why we have to use the book balance, right? Whatever it's on the books for, that's what we got to get it off the books for, okay? Totally different from when we're contributing assets, right? When we're contributing assets and starting a partnership, we use the fair market value. When we're taking everything off the books, we have to use the book value, okay? So we got inventory off the books. Now we need to recognize our equipment, right? We sold our equipment. It's worth $20,000. We got to get it off the books. Super easy to do. I'm going to credit equipment. For the amount it's on the books for, which is $20,000. Okay? That equipment that's on the books has accumulated depreciation associated with it. Well, we're getting the equipment off the books. We have to get the accumulated depreciation also off the books. So I'm going to debit accumulated depreciation for the $8,000. Okay? All right. So if I look here, I see that my credits sum up to $80,000. I'm just going to put this over here. And I see that our debits equal $65,000. I'm just going to put it down here. Okay. There's no need for you to do this in your problem. I'm just showing you debits and credits don't equal. So we need to calculate what all our non-cash assets were, right? We need to put them in, we need to do our calculation. So I'm going to come down here and I'm just going to do our calculation. This is actually part 2, right? Part 1 says a total of $55,000 was received for converting non-cash assets into cash. Great. Part 2 says calculate the gain or loss that we realized from selling those assets, okay? Or I apologize. 2 is for the capital accounts. We're still in part 1. We need to calculate, did we in fact have a gain or loss on the asset? Well, let's think about this, okay? First thing we need to do is figure out what is the net value of non-cash assets, okay? Well, that's easy, right? Because we had, and I'm just going to do it over here just to show us, okay? We had equipment. The equipment had a value on the books for $20,000, right? Accumulated depreciation was negative $8,000. So if we add this up, our equipment is $12,000. That's the value, okay? Next, we need to get the receivables off the books. Well, what are the receivables on the books for, right? Well, think about it. We had $25,000 of accounts receivable, less our allowance for doubtful accounts. I'm just going to abbreviate that. And we had an allowance of $2,000. So that then means what is our net accounts receivable? Well, we just have to sum these up. 25,000 minus 2,000 gives us $23,000. We also got rid of our inventory, okay? Equals our 35,000. So our net value of all the non-cash assets, 12,000 worth of equipment plus $23,000 worth of accounts receivable plus inventory of $35,000, we get 70 grand. Okay, great. What are our sales proceeds? Well, the problem told us we received $55,000 in cash. Okay, if we take the difference between these two, we have a loss of $15,000. Okay, so this is our loss on sale of non-cash assets. Okay, this should have been a review because we talked about this in chapter 10 when we were booking depreciation, putting assets on the books, taking assets off the books. So remember, when we have a loss, I need to debit that. So I'm going to have loss on realization or loss on sale of non-cash assets of $15,000. Oh, of $15,000. Okay. So now I could see that my debits equal $80,000. My credits equal $80,000. So there's my journal entry. Okay, so when you do yours, keep in mind that this right here that I did is a calculation. Okay, please don't get confused the fact that I put it within the journal form. I'm just showing, hey, here's my calculation and here's my net loss. Okay, so the next thing we need to do is figure out, well, we have a loss. So now we need to allocate it to the partners. Okay, so that's easy for us to do, really easy. Okay, so on April 30th, we're going to allocate the loss. So let's think about this, right? Who are our partners? Well, we have Mallory Capital, we have Bosco Capital, and we have Renteria. That's a weird name. Renteria. Okay. Capital. And then we're allocating this loss, right? What is our loss on realization? Well, it's $15,000. Okay. So think about it this way. We're closing out our loss account, right? We have a loss of $15,000. We need to allocate that loss to the partners. That's what we're doing here. So I then need to credit loss on realization. Okay. So if that account, loss on realization, has a debit balance of $15,000, to close it out, I need a credit balance or a credit entry of $15,000. Okay. So now we got to figure out, how are they sharing this, right? Well, they tell us it's a 5-to-3-to-2 ratio, right? So that means that Mallory, her calculation is going to be 15,000 times 5/10. Bosco's calculation, he gets a third. So to calculate Bosco, the calculation is going to be $15,000 of a loss times 3/10. And Renteria, her portion is 2/10, right? 5 to 3 to 2. So her, there we go. So her calculation is going to be 15,000 times 2/10. Okay? So super easy for us to do, equals 15,000 times 5 divided by 10 gives us $7,500. Cool. We do the same thing for Bosco. 15,000 times 3/10, because that's his portion of the loss. Usually helps if you put equals in there. And we're going to do the same thing for Renteria. 15,000 times 2/10, and we get $3,000. So if I add all these up, they do in fact equal our $15,000. So we've allocated this loss. Okay. The next thing we need to do is to show that we have cash, right? We had 30,000 originally. We got 55,000 from selling all those non-cash assets. So that means that we have a total of $85,000. Of this $85,000, guess what we're doing? We're going to pay our liabilities. Okay? So, to get rid of our liabilities, 30th, we're going to debit notes payable. We're going to debit accounts payable. We're going to debit salaries and wages payable. And those are all our liabilities. We need to credit cash because we're paying them off. Okay? So, super easy. What are my notes? Well, they're on the books for 20 grand. I got to get them off the books for 20 grand, right? I'm paying that note payable off. So I need to debit notes payable for $20,000. Same thing with accounts payable. I owe suppliers $30,000. I'm paying them cash. I need to decrease my accounts payable. Accounts payable is a liability. Decrease it with a debit. Same thing with salaries and wages payable. Has a balance of $2,500. I am now paying that. So we don't have that salaries and wages payable anymore. How much am I crediting cash? Well, the sum of all these, which is $52,500. Okay? So now what we need to do is, excuse me, we need to go ahead and we need to do part 4, which is cash was paid to partners with credit balances. So here's what we're going to do, right? Think about it this way. We're going to list out all our partners. Okay? So I'm going to come over here and do it. We have Mallory, Bosco, and Renteria. Okay? So they have a balance, right? Mallory started off with 28,000. Bosco started off with 13,650, and Renteria started off with 5,850. Okay, this is their beginning balance of the capital accounts before we allocated any loss. Okay, so that's number 1. Figure out what their beginning balance is. Next, we need to figure out what is their allocation of loss. Excuse me. Apologize. Okay. So Mallory, right here, we gave her $7,500. Okay. Bosco, we gave $4,500 to. And Renteria, we gave $3,000 of the loss to. Okay? So we've allocated the loss. The next thing we need to do is figure out what is their capital account value now. And all we do, since I have a negative, I'm going to go ahead and add all these up. Okay, so this is what we need to pay them. Okay, notice what their total is, $32,500. Okay, so let's think about it this way. We're going to do a T account for our cash. Okay, and the reason why is because I want to show you that we are allocating all the cash that's left. First of all, we sold all the non-cash assets, right? We got cash for them. What's the only asset sitting in the organization right now? Cash. We paid off the liabilities, right? So we had assets equal liabilities plus owner's equity. We paid off the liabilities. So now we have assets equal owner's equity. So we got to make sure that the cash that's left is enough to pay the owners their investment into the partnership, right? So we started off with, and bear with me here, we started off with $30,000. Okay, we added $55,000, right, from the cash proceeds that we received. And we subtracted, or we credited, $52,000, right? Okay, so what then is our balance of cash? Well, that's easy for us to do. All right, equals, add up our debits, subtract out our credits, 32.5. That's our cash balance, which incidentally equals the owner's equity. So what we're going to do is we're going to go ahead now and pay or disperse the cash asset to the owners. And we're doing it on April 30th. So we're going to debit first Mallory Capital for the amount of $20,500, because that's how much her capital account is worth after selling all the assets, paying all the liabilities. Okay, we do the same thing for Bosco. Bosco Capital is going to be debited because he's taking his money and he's leaving. We're going to debit that for $9,150. That's the amount of his capital account after we allocate the loss. Okay. Finally, we have Renteria Capital, and we're going to pay her $28.50. Okay. We're going to credit cash for how much? Well, it better be $32.5, but I want to make sure all my debits. There we go. So the partnership is now dissolved. All the non-cash assets were converted to cash, paid all the liabilities, and returned the capital that owners have in their capital account to the owners in the form of cash. Okay, so that is 12-3B. We're going to come back and we're going to do 12-4B. So thanks for tuning in, and we'll see you back here in a little bit.